Hello, this is Doug Gerlach. Welcome to our Investment Club webinar. Today is Tuesday, March 15th, 2016. Beware the Ides of March. In this date in 44 BC, Julius Caesar was assassinated, and we celebrate or we commemorate his life every day with that saying about the Ides of March, which of course no one understands what it means, but we do acknowledge it here today. Today with me is Russell Malley, who's going to help us out as we talk about my rules for a healthy investment club portfolio. Before we get started and before we bring Russell in, we'll review our regular housekeeping, our regular welcome message. If you're having technical problems, we always recommend that you get in touch right away with GoToWebinar on their toll-free number or on their website. They are standing by 24 hours a day to provide support to you as a webinar attendee. So if you're having any sorts of technical problems, get in touch with them right away. Some things you can do if you can't hear me at any point, if the sound or graphics are choppy, if my voice starts to drop out, it's probably your connection or your computer. So we recommend that you turn off any unnecessary programs that are running in the background. Don't connect using Wi-Fi if you can help it, and you can always listen using the telephone. The telephone number and the instructions are in the GoToWebinar email that you received about tonight's event. At any point, you can type in your question into the questions box, the GoToWebinar screen. You don't need a microphone. We'll answer your questions during the presentation, and we'll have some time at the end as well. So feel free to use that question box at any point to get in touch with us. Also, you can download the handout for tonight's presentation by clicking on the PDF icon there in the Handouts tab of the GoToWebinar application. Do grab that right now if you'd like. I have a special one-page investment club report card that I'll be talking about later that you can use in your own investment club to help evaluate your club portfolio and your club's portfolio practices. Our complete archives of webinars, as well as our schedule of upcoming webinars, can all be found on myICLUB.com, which is our corporate website. Click on the Learning tab at the top of the page, and you'll be able to navigate to the webinars section. Our upcoming webinar schedule includes this Investment Club webinar next month on Tuesday, April 19th, 2016, our Toolkit 6 user group webinar on Tuesday, April 5th, and our lunchtime stock club on Monday, April 11th, 2016. So we've got an action-packed April with lots of webinars, lots of opportunity for you to learn more about investing, investment clubs, and stock analysis. So check out that schedule and watch your email for updates there. You can also follow us on Facebook. If you look for iCLUBcentral, you can find our page there for occasional updates, for links to special offers, and news about upcoming webinars and the release of viewing videos that are available for viewing on demand of archived webinars. So please do check us out there. Now, before we get too far into tonight's presentation, as of today, March 15th, the federal club tax printer and all state club tax printers that iCLUBcentral produces are final and have been released for both Club Accounting 3 and myICLUB. So if you're going to myICLUB and you're not seeing your state or your federal tax printer there and you're wondering when they're going to be released, that probably means there's a problem with your order, with your account. Maybe there's a duplicate record. So you need to contact our support team right away and they will get that straightened out for you. Our last state, Georgia, was released yesterday, March 14th. And we had 3 releases at the end of the prior week for New York, New Jersey, and Wisconsin, I believe. But that rounds out all 14 states that we produce state tax printers for. So they are all final and all are available for you to file your club state return. By now, you've probably completed your federal return and distributed K-1s to your investment club partners if you're the club treasurer, and that's great. Though those The federal module has been done since January. So as soon as you got your 1099s, you should have been able to complete those. So thanks to Russell for his help during tax season. He's saying finally the support inquiries are slowing down a bit. So we hope that most of you have completed another successful club tax preparation season. And I don't want you to start worrying yet, but in 2017, next year, the deadline for the Form 1065, the partnership return, has been moved to March 15th from April 15th. So that means you'll have one less month to file that federal return next year. So this year we're still on the April 15th deadline, but next year the deadline moves to March 15th for the federal return, and we have no clue what the states are doing yet, if they will follow that deadline or maintain the April 15th deadline. But just keep that in mind. We'll be communicating that, messaging that, and working our schedule to accommodate that earlier deadline so that you will not be up against the wall at the last minute. So make sure your club members are aware for next year. So again, we're talking about the 2016 tax year for returns that are due in early 2017. So with that, let's talk about my rules for a healthy club portfolio. Joining me is Russell Malley. Russell is iClubcentral's official club accounting advisor. He's the right man for the job since he has more than 20 years of experience, not only being a member and an officer of investment clubs, he's also worked as a support representative for iClubcentral's predecessor company, EasyWare Software, and he's also a volunteer and a past officer of the Silicon Valley chapter of Better Investing. So he is someone who really knows the investment club space and can offer a whole lot of expertise on investment club accounting. So Russell, welcome to our webinar. I'm happy to say that here in New England, we've had a spate of good weather, so no longer do I have to sit here in sub-zero temperatures and hear about the sunshine and warm temperatures that you're experiencing out on the West Coast. But hopefully you've had a little rain as well, so maybe things are changing up a little bit for the better.
Well, we've had a lot of rain recently, and we're having a break right now, so it's been really nice and sunny. And the hills are green. I know people think that's weird in the winter, but our hills are green.
No longer the Golden State, at least for a couple months of the year.
Yeah.
Well, good. Well, we're going to talk about portfolio tips for investment clubs. A lot of these are just as applicable to individual investors who follow the Better Investing approach. Some of the strategies, of course, are unique to investment clubs, but we're going to talk first of all about diversification. Diversification means that we're going to help manage the risk that comes from investing in individual equities by spreading out our stock selection by industries as well as sectors. So we're gonna invest in a number of different industries, and that will help us avoid concentrating in single industries. The learning experience that many investors gained about this at the end of the 1990s bull market, when technology stocks were all the rage and investors loaded up on technology, they learned that when the crash came and the technology stocks and the NASDAQ dropped more than 50%, that their overweight in one sector was not a very effective way of limiting the risk in their portfolios. So we suggest that you spread out into a number of different industries, and not only a number of different industries, but a number of different sectors as well. Some of the red flag industries that I often see investment clubs overweighted in include retail and consumer-facing businesses, consumer goods companies, restaurants, and healthcare, kind of brand name businesses or large cap stocks that everyone's aware of. And so when you invest in those kinds of companies, you're not getting as much risk reduction as you would if you spread out into basic materials and industrials and some of the less, quote, sexy industry groups. On the sector side, as growth stock investors, we tend not to invest too much in utilities or energy stocks or transportation stocks. They just don't have the growth potential that we look for, that we demand in order to meet our capital appreciation goals. But most of the other sectors are you can find reasonable candidates for your portfolio. Now, one approach, and this might be a good exercise for you to do, this is something that Phil Keating, who's a longtime Better Investing volunteer and instructor for the Southeast Florida chapter, he suggests that you compare your portfolio sector allocations to the allocations of sectors in the S&P 500. So you can find those online. You can find how much of the S&P 500 do financial stocks, do technology stocks, do real estate stocks now. How much do they take up of the makeup of the overall S&P 500 index, and then compare your exposure in your your club portfolio to that, and that can kind of give you a sense of where you are in terms of tracking against the overall U.S. business economy / market, and that can be something interesting to do. Now, when you're looking at sector and industry diversification, of course, the myICLUB has graphs and reports that make this real easy to do. And it's not something you need to do necessarily every month, but it's a great idea to take a look at your diversification before you make another purchase so that you're not, again, overweighting in a particular group. If we come over to the myICLUB website, here in the portfolio reports, we see the sector and industry diversification report over here on the right. And we moved it up to the top because we think it's a really important tool for clubs to be looking at their sector and industry diversification. And the report rather takes a little bit of interpretation. We've got the sector first and industry second. So you see as you go across sector, here's the sector. Then we have the industry, here's the industry. And then we have the security, here's the security. Then the market value, the percentage of that security, and the percentage of the industry, and the percentage of the sector. So you can get a lot of information kind of packed into a short amount of space here. But I know that Russell really likes, if you keep scrolling down, you'll get the graphs of the sector and the industry. So this can give you, again, a good clue as to the weighting of your portfolio in various sectors and industry groups. So here, the consumer cyclical at 32% is a little heavy for consumer cyclical stocks. As you come down here, you'll see it's actually in two different industries: specialty retail and footwear and accessories. Healthcare at 25.3 is also a little heavy. Consumer defensive at 12.3 is pretty reasonable. And then there's real estate, industrials, technology, and then there's some unknown and cash and other in this portfolio. So the sector diversification, again, you have a little idea. Maybe you want to get away from these cyclical stocks. When we have a recession, this portfolio is going to take a pretty big hit, this sector especially, because of that 32% exposure to cyclical stocks. As you move down to the industries, here you can see the breakdown in the industry groups. So that's much better. There's still one big overweight here, and 27.5% of the portfolio in a single industry, the specialty retail industry. But as you scroll around, you can see pharmaceuticals, biotech, drugs, medical devices, et cetera. So things looking much better on that side. And finally, you can drill down to the companies. And here we see that O'Reilly makes up that big 27.5% portion of this particular portfolio. So there's a lot of good information here. And then finally, down here at the very bottom, look at the sectors not represented. So this is just a great clue that here's where we might look for stocks, basic materials, financial services, maybe communication services. We're not so worried about energy or utilities, although you can find some that fit a growth approach occasionally. Energy, certainly a lot of volatility, especially recently. So you can check out those reports there. And again, this is helping us drive the direction of the club's portfolio to fill in the gaps in the diversification.
Dick, I just wanted to make a point about the graphs. It's not that so much. It seemed to make a much bigger impact on my club when they see the graph rather than the report. I mean, the report's very nice, but when they see that graph, they just seem to spot where we're have a deficit in our management of the portfolio with the graph. It just pops out at them a lot better.
Yeah, and if you notice, the colors here match up between these three graphs, so you can really, it doesn't take a whole lot to kind of figure out the correlation between, what industry, what sector, and what company. And I agree. I mean, I think these pie charts here really tell the story, really express to your club members how your portfolio is looking from a diversification perspective. It includes cash, it includes unknown, securities that we don't know anything about if they're not stocks. Like in this case, we've got ETFs and some other odd securities in this test club that show up as unknown. And it's 5.5% is not so bad for a portfolio. I'm sorry, it's actually a little bit less than that. They're pretty small. It's about 4% of the holdings there in that unknown. And again, that's okay if you occasionally want to stray from your growth stock approach. Well, let's keep moving on. We'll talk about the next diversification element is diversifying by company size. And you may have seen some news from Better Investing that officially the suggested company size guidelines have been updated, are being updated, and we are following along with our iCLUBcentral tools. And so our new company size guidelines are based on revenues, not by market cap. We look at revenues to measure company size because it tells us how strong the company is or how big the company is on a fundamental level, not on an investor sentiment level. Market capitalization is determined by how many shares are outstanding and what the share price is. So a small company could have a big market cap, and that isn't useful for us in measuring how that company fits into our portfolio. So we have new company size guidelines. These have been rolled out into myICLUB, so the reports that we'll take a look at will show you that. And Better Investing's guidelines are that for your portfolio, your club portfolio, your personal portfolio, that you should have about 25% of your portfolio in large company stocks with revenues greater than $10 billion. Small company stocks should be 25% of your portfolio. These have revenues below $1 billion. And then in between, those companies with revenues between 1 and 10 billion the mid-sized companies should make up 50% of your portfolio. And again, there's a great graph or report on myICLUB, if we go back, that will show us, if we look here at the company size diversification report, gives us that same breakdown. We add in micro companies and mega companies. The micro companies have revenues below $100 million, and the mega companies have revenues greater than $50 billion. And again, often the micro companies are too small to warrant consideration by most investors, by most Better Investing style investors, and the mega companies are so large that they can reduce your total return because they don't have the growth potential. They're so big already, their growth rates are not going to drive them. So in this case, you can see the unknown, the small, the mid, the large, the mega, the cash and others. And then of course we have the graph. And again, the graph, this is an interesting graph in that it's got an inner circle here and an outer circle. And the inner circle shows us the breakdown for mid, small, large, mega, and we have cash and other and unknown here. And then as you work your way out from the mid-size, for instance, in this case, 44.5% of the portfolio is mid-sized. As you move out, you see we've got Stryker, O'Reilly, and Fastenal, who are mid-sized companies that make up that. Same thing with Mega. We see that WBA, Apple, Target are the companies that make up the Mega. So you can get a good sense of where your portfolio is. In this case, the mid-size is pretty close to target if we accept the 50% target. Mega and large, however, is close to 35% or so. So that's a big exposure to the slowest growing stocks in the portfolio. And the small is less than 10% with just 2 companies in the small category. So again, how this portfolio is more likely to perform is it's going to be really close to the market averages. It just doesn't have enough growth potential to drive it above the averages of the overall market. It's probably got a fairly significant dividend being paid by those large and mega companies, but there's just not a whole as much growth potential as we really like to see. So again, this fits into your new stock purchases. If you see this graph and you say, yes, we accept that better investing target, then you're going to be looking for small companies, and you're going to be looking to replace perhaps some of the large and mega companies to get that diversification back in line with the target. So this chart just really makes it real easy. And if you click here on the recommended stock diversification chart, you can see that better investing recommendation there. So that's something for you to definitely take a look at and use that in your club portfolio. As we keep going on, my third tip is, as we go back here, just my notes here too. One of the things you can do is consider the growth rates of the companies, and that's something that I do sometimes when I'm looking at a club portfolio, is calculate the projected growth rates and then wait, in a spreadsheet, you can figure out what's the total average growth of the companies that you own. And sometimes people are really surprised to find that their portfolio really only has projected growth on average of 11% if you look at the analysts' projected growth rates for the companies that they own. And that's why they keep wondering why they can't match the market performance. It's because they're overweighted with lower growing companies. So that's something to take a look at. And a way to think about your company size diversification. My third tip, so when we're looking at diversification, we want to look at people often want to know, how do we rebalance the portfolio? So, I have some rules of thumb. For one thing, I suggest that no stock and no industry group be less than 3% of your portfolio or more than 15% of your portfolio. Now, on the more than 15% side, companies typically end up being overweighted because they perform well over time. And so I don't suggest that you're going to automatically sell any stock once it gets to be greater than 15%. But that's just, again, something that you want to watch out for. Take opportunities to transfer highly appreciated shares. We'll talk about that later. And keep that in mind, that you are increasing the risk in your portfolio when you have single stocks that make up more than 15% of your total. And then on the low side, if you have a rule that no security should be less than 3% of your portfolio, that's going to really help you to make sure that every purchase that you make is going to be a significant purchase that can contribute to your club's return. If you're buying stocks and they're only 1% or 2% of your total portfolio, let's say you buy a stock, an initial position, and it's 1% of your club portfolio. If that club doubles, what's the impact on your total portfolio return? It's like 1%. So it becomes 1% to 2%. So it's not having a big impact on your portfolio return. And even if it does go double in value from 1% to 2%, then are you going to buy more? Most clubs say, no, we should have bought more, but we're not going to buy more now because it's too expensive. Well, so now you've just shot yourself in the foot. If it goes down from 1%, you're going to say, well, it's a good thing we didn't buy more, but because look how much money we've lost, which is not very much, but it was only 1% of your total portfolio. You can go to zero, and it has very minimal impact on your overall portfolio return. So 3% to 5% is where I suggest that you should be starting your investment positions. And the bonus of that is that you really have to make a commitment to the stock. And we'll talk more about the number of securities in your portfolio. My objective for rebalancing, my suggestion is that we don't simply sell stocks because they reach arbitrary percentages, but we look at our capital gain loss review. We use this as a guide to future stock selection, and we set goals for the club. So maybe you sit down with your club and you look at your diversification and you say, all right, we don't have any basic materials or industrial stocks, and we're underweighted in small companies. So let's go out, use the screening tools that are available, keep our eyes and ears open, and try to find some stocks that will help fit into our portfolio and provide important risk management and risk reduction to our overall portfolio. And that's going to be a productive way to build your portfolio over time. So I just talked that we're going to talk about not owning too many stocks, which is a problem. There are a lot of better investing members and investment clubs that simply own a lot of different stocks. Traditionally, 20 years ago, the rule of thumb was don't own more than 10 or 12 stocks. That's all you need to give you a good amount of diversification. But the problem is that the market has changed over time, and new research is really suggesting 15 to 25 stocks will give you the best benefits, the most benefits of an all-stock, all-equity portfolio. Of course, in a club, you might have a rule that no more than 1 or 2 stocks per member, and that would be okay. In a smaller club, you might have to up that a little bit. You want to make sure that members can follow the stocks that they're assigned effectively. And again, if no stock is less than 3% of your total portfolio, we're already starting to limit the total number of securities that we can include in our portfolio. Some of them are going to be much more than 3%. You're going to reinvest in some of the companies that when the opportunity arises, you're going to have some that perform really well. So we're not going to have a portfolio of 34 stocks, all at that minimal 33% level. But we're going to get rid of the distractions that come from owning stocks that only make 1 to 2% of your portfolio. So why do we say 15 to 25 stocks, 15 to 20 stocks is good for a portfolio perspective? And that's because we diversify by including a number of stocks in our portfolio, individual securities, because as we add more and more securities, we actually reduce the risk in our portfolio. But there's a certain point at which we can't reduce the risk any further. That's the level of risk that just comes from investing in the stock market. So this graph shows us, and I'll talk you through it here. On the left side, we have the standard deviation of risk. In essence, the volatility of the stock as a percentage here. So we see from 35 to 10 on this side. And then down below, we have the number of stocks from 1 all the way up to 100 different stocks. Now, this line right here is the market risk, the level of risk in the overall market. And you can't diversify away market risk. You just can't get rid of it. If you're investing in the market, there is risk, and that risk level can't be diversified away. It can't be removed by buying a lot of different securities. So in this case, if we start here with 1 stock, I'm going to flip over to my pen instead of the highlighter here. If we have one stock, here is the level. It's a very high level of risk in the portfolio. And that makes sense. If you had a one stock portfolio, all of the risk in your portfolio is tied to one stock. That stock goes up, your portfolio goes up. That stock goes down, your portfolio goes down. As we add stocks, you can see the risk starts dropping significantly. It really starts dropping significantly. When we get to 10 stocks right here, we're at a much lower level of risk, so say 17% standard deviation. So you see we've gone from 30 to 17 by just adding 9 stocks to our one stock portfolio. But from this point, we continue to add stocks. So here we are at about 20 stocks. We've reduced it a little bit, but what we've gone down to 16% maybe, right? So we haven't reduced it by adding 9 more stocks. We haven't reduced the risk very much, and we can continue to add. And then somewhere in this area, here's 25, we can keep adding stocks. And are we reducing risk? We're not reducing it significantly. And you can see when you get out here to 100 stocks, the market risk and the portfolio risk are the same. In other words, you've just replicated the overall market or an index fund, except you're paid commissions to buy 100 different stocks, and you're tracking, you're spending resources to track 100 different stocks, when it would be much easier to just buy an ETF, an index fund, and be done with it, because that's what you own at that point. So everything from 25 stocks up is just not helping to reduce the risk in your portfolio. So that's why I suggest that for individuals and for clubs, holding more than 20 or 25 stocks, so somewhere in this area here, is where you're just not reducing the risk. And in fact, you're increasing the chance that your portfolio is going to replicate the returns. It's going to regress to the returns of the overall market. So somebody tells you they own 50 stocks, they're really, in essence, owning the overall market. They're owning index funds by and large. Now, we're going to try to select stocks that have a higher return potential and a limited downside potential, which is another risk management technique that we use. But because we can't get away from the market risk, it's important for us to make sure that we are not overloading on stocks that makes it more complicated for us to follow those stocks, to manage a portfolio, and more importantly, reduce risk and generate the returns that you're looking for. So I hope that message is clear. I hope that you all take heed with that. If you look at your portfolio and you've got 3 stocks that are between 1 and 2% of your total portfolio, and you've got 30 stocks in your portfolio, and you've got 12 members, you know what? It's time to get rid of some of those smaller companies. And those shards that you have, those tiny positions, 1 to 2%, the good news is that you can sell them. You're not going to generate a lot of capital gains. The expenses may be a little high based on the positions that you own. But what happens is that sometimes, you hold a stock, it goes down so low that you figure, well, there's no point in selling it now. It's hardly worth anything, so we might as well hold on to it. But those are distractions to your club portfolio and your individual portfolio. That means they have to be valued every month. The stock watcher has to report on them. They're much better if you just clean them out and put that money to work. That is dead money many times for those particular companies.
Doug, I recently was helping a club analyze the data unrelated to this, but when I saw their data, I just had to comment on them. Their club has a value. It's about 10% lower than my family club, but they own 95 stocks.
Wow.
We own about 14, about 12 or 14.
Mm-hmm.
And I was trying to make this point to them through the email as I'm talking to their other issue and saying, you really should consider paring down these stocks. That's just too many for a club.
Yeah, it's amazing how often we see that. But there's a lot. Warren Buffett says the best way to invest in the stock market is to do your research, do your homework, study, find one stock that you really think has the potential to perform well, and then invest everything into that one company. And in part, he's saying you got to be sure of what you invest in. And if you were going to invest 100% of your portfolio in one stock, we would eliminate a lot of bad habits that we have, where we say, oh, well, we'll see what happens. Oh, let's go ahead and give it a shot. Oh, well, we'll figure it out. We'll learn as we go. We would be much more confident, and we would do a lot more due diligence and a lot more research and analysis before we actually make that purchase. But to support this concept of streamlining and consolidating into fewer companies, when you look at the best performing mutual funds over the years, time and time again, you'll see that you've got these smaller funds, maybe a couple $100 million, and they own 40 stocks. Once you get to be a large, a Fidelity Magellan fund where they're owning thousands of stocks and have billions of dollars in assets, it's hard for them to outperform the market because they have so many different stocks, and they're the slow-growing large cap stocks. They just can't invest in the smaller companies, and in any meaningful way. They're really restricted from investing in buying the stocks of small companies because in order to make it have an appreciable impact on the fund's portfolio, they would have to buy an excessive amount of that small company stock. We as individuals, we can afford to buy small cap stocks. We can buy significant positions in them, and we can benefit from them, whereas large institutions can't do that. So it's just very interesting if you start looking at it, at the number of holdings in mutual funds, and that's one of my criteria, is finding mutual funds, actively managed funds that have a lower number of stocks, not hundreds of stocks, but 40 stocks, 50 stocks, 75 stocks. Those are the ones where they're really doing the work. They're committing to those companies, and they are going to have a better chance of outperforming the overall market. Well, let's move on and talk about selling, which is often a problem where clubs and individual investors run into all sorts of problems. Well, Better Investing has the PERT tools, what I call the PERT principles, which essentially mean that after every company reports its quarterly results and its annual results, we review the company and we determine if continued holding of that security, of that company, is justified. So it means that 4 times a year at least, we're going to be doing an updated analysis of the companies in our portfolio, and we're going to determine if those companies are continuing to meet our objectives and have the total return potential that we're looking for. Often we run into situations where the companies that we're looking at, we don't have a good sense of the total return potential. The company may have had some problems, and so the tendency of buy and hold investors is to simply hold on and hope that things get better. But my strategy is to get rid of the word sell and to talk about replacing stocks that have limited upside potential or other problems that are creating uncertainty in our portfolio. If we think about replacing companies instead of selling stocks, we can move on and we can think about things like upgrading our portfolio on a regular basis. If we started every club meeting the stock review session by saying, what can we do this month to upgrade our portfolio? Chances are we would have a much different discussion rather than, okay, let's see how the companies in our portfolio have performed so far this year to date. We're really getting at 2 different answers by asking those very different questions. Chances are your club has a good consensus already built that some of the stocks that you're holding, not everyone is very confident about the potential for those stocks to perform well in the future, but yet you continue to hold them because you don't want to hurt the feelings of the person who recommended them or some other you're paralyzed by the uncertainty, and so we're going to hold on to it. We're going to wait and see, and waiting and see turns into years instead of simply quarters. So we want to, if you think about replacing stocks that have problems in your portfolio or limited upside potential, if you think about upgrading your portfolio whenever you can to higher total return candidates and better quality stocks, and we make this an active process of replacing, bringing in the fresh new companies that seem to be poised to outperform over the next couple of years, and getting rid of the stale companies, the has-beens, the also-rans. We're not turning into day traders by doing that, but we have the big opportunity to improve our portfolios. And overvalued stocks are just as a bigger risk to your portfolios. Underperforming stocks. Often those big winners we hold on to because they validate us as investors. We selected a stock, it went up, and now we're proud of our skill and our expertise, even though there was a big portion of luck that was involved in our selection and purchase of the stock at that particular time. And so we tend to hold on to it, even as it appears to be overvalued. So again, replacing stocks with stocks that have a better return potential over time is one strategy that you can use to improve your total rate of return. So we want to upgrade it often. We want to be It's okay to be patient. As long-term investors, we need to be patient, but it's also no good to be stubborn. Being stubborn and being patient often seem to be the same thing, but there is a difference. Stubbornness is resisting change when you know that maybe change is called for. So instead of sitting around being uncertain about the stocks in your portfolio and how well they're going to perform, whenever you're faced with uncertainty, whenever the answer to the question, well, how do we think this company is likely to perform, is, well, we just don't know. Nobody really knows. Things are looking kind of murky. It may take them a couple of quarters to turn around. Right then and there, we should be thinking, all right, can we find a replacement for this company that we have higher confidence in? And in every market, in every bull market, every bear market, every recession, every period of economic expansion, you can always find good companies that are temporarily undervalued, that offer a reasonable total return at their current price to justify swapping in and out those stocks. And of course, taxes are a concern, and we'll talk about capital gains and loss taxes. But I think one of the things that individual investors have been do least well is knowing when to sell. Individual investors actually do a pretty good job of knowing when to buy stocks, but we hold on too long, both to winners and to losers. And so trying to accelerate that sell decision can often be a good move. Now, I'm not saying that we're going to sell our winners and let our losers grow. We're going to take a balanced approach. We're going to worry about the fundamentals first. So we're going to deal with the losers first. And then after we're satisfied that we've replaced those underperforming stocks with better quality candidates, then we can take a look at the overvalued situations that we have and start dealing with those companies.
Doug, I found a very nice quote about your winners, when you have winners, and being proud of them. And I'm sorry, I can't attribute it to who it was, and that was, don't confuse a bull market with your extraordinary stock picking skills. Sometimes it's just luck. You happen to be investing in a bull market. So
yeah, and we are in a bull market. We've been in a bull market for 7+ years now. It doesn't always feel like it. This is a weird bull market that's had some sideways periods to it. But yeah, we want to acknowledge that over time we're likely to be more right than wrong when we're making decisions using the stock selection guide. But we just need to make sure that we have a principle in place for knowing when to sell stocks, and we're not afraid to sell securities, both that are underperforming and the ones that have done well, when it will serve our portfolio. Number 5 is just a reminder about the fees and expenses in your club. My rule of thumb about commissions is that the commission on any purchase should be well less than 2%, and these days much closer to 1% of your total investment. I've run into clubs where they invest $300 a time and they pay, you know, a $10 commission. So every time they invest in a stock, they're 3% behind plus. And then they wonder why their portfolio is not performing so well. So if you have this 1% rule and your broker charges a $10 commission, you want to be investing $1,000 at a time at a minimum whenever you're buying, making a stock purchase at that broker. And again, every time you have a 1% commission, your stock has to grow more than 1% in order to cover that commission cost and get you back to zero. If your commissions are totaling more than 2% to 3%, and again, it used to be 3% was the rule back before discount and discount online brokers were available. Again, you're starting out by digging yourself a hole, putting the stock in it, and now you've got to wait for it to grow enough to get out of the hole, and then you're starting to earn returns after that. So you want to watch it out. And the other advantage of this is, again, we're making sure that you're going to invest. Whenever you make an investment decision, it's going to be a solid commitment that you're making to the company by keeping this rule into place. The rest of your expenses in your club, again, some of them are tax deductible, but you know, the thing about tax deductible investment expenses is that it helps virtually no individual investor, because there's a floor on your personal return that you can't deduct individual expenses until they exceed, what is it, 3%, 2% or 3%, Russell, of your AGI?
It's 2%.
It's 2%. So anything,
and it's only the amount above 2%.
Above 2%, exactly. So if you have adjusted gross income of $100,000, only your investment expenses that exceed $2,000 have any impact on your taxes. So we want to keep expenses as low as we can in your investment club. And fees or commissions really are one way that we can help keep those costs down as well, even though those don't show up in the investment expenses. We also, yep, go ahead, Russell.
Tell people about that. In 23 years of my investment club, I've been able to deduct on my personal income taxes some part of our club's expenses once. And that was a really special year. It included a job change and stuff. So we had a lot of other miscellaneous expenses not related to the club. So nearly always figure you're not going to be able to deduct your club expenses on your personal.
Yeah, it's just not, you know, you record them, people faithfully enter them, they show up on the K1, but again, the vast majority of your members are not being able to take advantage of any tax deductible investment expenses. So you want to keep all of your costs as low as possible. Now, my sixth tip is to be tax smart. There are a number of ways to be tax smart in your club. We talk a lot about how to handle fully withdrawing members. And it's always great to transfer highly appreciated shares to those fully withdrawing members whenever possible. So those are the stocks that you've owned that have tripled, quadrupled, quintupled in value. Now the club doesn't want to sell them because there's a significant capital gains tax, capital gains that we realize that everyone will be taxed on. So in a full withdrawal situation where a member is leaving the club, we can transfer those shares of that highly appreciated security to the withdrawing member. The tax impact to the withdrawing member immediately is zero. It's just like they got cash. The only difference is they got stock instead. They don't take the club's basis in the stock. The club's their basis in that transferred stock is going to be related to their basis in the club. So they can then control the gains that come after that if they hold on to that security for 5 or 6 more years, or if they sell it immediately. That's their decision. But for the remaining partners, all of those capital gains that would have been realized immediately get deferred. until the remaining partners, one by one, each leave the club. They then take their share of the deferred capital gains. So we're not eliminating gains, but what we're doing is we're saying, you know what, you're going to incur the gains now, but we're not going to actually pay them or have to pay taxes on them to the IRS for maybe 5 years, 10 years down the road when each member subsequently leaves the club. So this has to do with IRS regulations around investment partnerships that have more to do with physical property. So for instance, imagine that you're in a partnership and you own a bunch of houses and you're renting them out, and now someone wants to leave the partnership. And in order for you to be able to cash out that partner, you would have to sell a significant amount of property, and maybe the market's down or maybe the market's up, and now the rest of the partners have to pay significant capital gains taxes, or they're incurring losses because they're selling this property. So the IRS is saying, that's all right, just transfer them property, and then instead of paying them with cash and being forced to sell, and we'll give you a little break on when you have to pay the taxes that are due. So it works just as well, though, for securities, for equities, and so that's why we always counsel clubs to take advantage of this whenever they can, to defer the realization of capital gains instead of having them come due in the next tax year. So I don't know anyone who says I would rather pay my $300 worth of capital gains taxes now instead of 10 years from now. But that's what the impact of this method of transferring highly appreciated shares to fully withdrawing partners does. In other ways, you can make decisions in your club to sell securities at a gain and offset them with securities that are sold at a loss, and you can avoid the realization. You can offset the gains taxes with capital losses. I believe that even though clubs are pass-through entities, that you want to strive to be tax neutral in your operations each year, which means that if you have capital gains, look to your losers that you can sell even just temporarily to offset the gains in your club portfolio. And so you can do this capital gains review, particularly at year end. I like to do it in October or November so that we kind of avoid the year end selling spree, and then maybe take advantage of being able to repurchase stocks that were sold at a loss in January when the market generally gets a little bit of an uplift. So check and see if there's a surplus of gains over losses, and then you can consider selling some of those loser stocks, sell those underperformers, sell them temporarily, right? Just to acknowledge the loss, and then you can repurchase them at a later date. We'll talk about the wash sale rule in a minute. If you've got a surplus of losses over gains, so you have some securities that just didn't work out, you sold them, you've got a big loss now. Well, that's great. Every member will be able to take that loss, and it'll give them some positive benefit on their tax returns. But that might be the time to thin some of those overweighted positions in stocks that have really gone up in price. So sell some of those shares in those highly appreciated stocks, eliminate the capital gains, so they're offset, the gains and losses offset each other. And when you do that, you can actually buy those stocks, the appreciated stocks, you can buy them back right away. If you really are committed to holding them, sell, and without having any capital gains to worry about effectively, and repurchase them right away. Use the same money, repurchase again fewer shares, or the same number of shares, and that will get you going if you really think that the stock has a lot of room to grow. We have a capital gains journal in myICLUB that you can check out and get you that. Just a few notes on harvesting. That's what we call this, harvesting gains and losses. Harvesting is just about selling, even not based on necessarily on the fundamentals, but just based on smart tax principles to help you rebalance your portfolio, help you reduce exposure to overweighted industries and particular securities, and to get rid of companies that might have fundamental uncertainty attached to them, and you're not sure what to do. You can't make a decision to sell or to continue to hold or to buy more. So if you sell for tax reasons, we're going to eliminate those companies from consideration, and we can review them later on. Um, I mentioned that often we make these tax sale decisions with temporary intent. So the wash sale rule, however, says that when you sell securities at a loss, you can't repurchase the same security until 31 days later. So the IRS is aware that you may wish to harvest losses occasionally, but it's not fair to sell it at a loss and then buy it immediately right back. So what happens in that case is the IRS will disallow some or all of that loss. There's a formula that they have. But if you wait until 31 days, you can repurchase it at that time. So this is often effective in a club situation where you've got a stock, nobody likes it, but nobody wants to take the initiative to recommend selling it. They don't want to hurt the feelings of the person who brought it to the club. But everyone can get behind selling it so that we can record the loss, so that we can offset our gains, and in the current tax year, everyone can benefit from getting rid of this stock. And you know what? At our next meeting, let's reevaluate it, and we'll see if we want to repurchase it at that time. So this is a very good exercise. Generally speaking, in my club, whenever we've done this as a matter of course, whenever we sell stocks to generate a loss, but we never buy them back. We always feel like, you know what, there are better opportunities out there. And so in the end, everyone is very pleased with the decision to match sales and loss. So in the handout, I have an investment club report card that goes through the things that we've talked about tonight, the elements here for diversification, number of size of holdings, the overall investments, and just two boxes, either good or needs improvement, and then a form on the end, a space on the right side for suggested action. So you can go through and make sure that everyone is happy with the club's diversification and set some targets over there in the suggested action category. So that, I think, is maybe a good experience that you can take back to your club as an investment education effort at your next meeting. All right, it's time for questions if you have any before we wrap up tonight. I see Ernie says that our bank has imposed a $1,500 minimum in our investment club checking account. I would like to know of any brokerage company that will allow us to deposit our individual funds directly. I will tell you that my club uses TD Ameritrade, and we do that specifically. We are able to deposit checks. TD Ameritrade has branches, so we actually are able to, our treasurer takes the club checks to the branch, endorses them in a certain way, and they are deposited. Other brokerage firms will allow you to do it if they are paid, if the payee is something like XY, would be like XYZ broker, FBO account number, for benefit of account number, 112233445566. So everyone writes the check. It's payable to the brokerage firm, but it's marked for benefit of your club account number. And so that is another way that some brokers prefer to handle those types of deposits. So if anybody else has any other brokers that allow individual checks from members, please let us know. Russell's club also uses TD Ameritrade, right, Russell?
Yes, they do. And the checks come to me, and I can actually, even though there's a branch fairly nearby, it's about 20 minutes away from where I am, they allow us to mail it to the branch too, so it goes in. I just collect them, put them in the mail the next day after the club meeting, and that's fine. And they show up in our account.
Yep.
We do have to put the account number on there somewhere, but the checks are usually just made out to TD Ameritrade, and then somewhere on the check there has to be reference to our account number.
Yeah, so it's really not that uncommon. So that's two clubs that are using TD Ameritrade, and I've heard of it at other brokerage firms. I don't know offhand. who also supports that at this point.
But the other point I wanted
go
to
ahead.
point on that, when you're making expenses and stuff, TD Ameritrade, and I know other brokers also allow it, that you have check writing privileges on your cash account at the broker, so you can get rid of a bank account completely.
Yeah, that's always great. Again, that might depend on the size of your club in order to get those check writing privileges, or they limit you to a certain number, 2 checks per month or something, which is generally fine for most investment clubs. So you don't have to worry about um, uh, uh, the lost my train of thought
Bank
here.
fees,
Yeah.
bank account.
Yeah, eliminate a bank account. Carolyn says that Scottrade allows checks from individuals and her club mails monthly deposits to the broker. Yeah, my club sometimes they're mailed, and sometimes, depending on who the treasurer is at the current time, it's an online club, so we're all over the country. So sometimes we mail our checks to the treasurer, and he or she deposits or mails them to the broker, and they get, the problem is, when you're depositing checks at a bank, either by mail or in person, they have, this is what they do, is they process checks. Brokerage firms don't process a lot of individual checks, so we have had instances where the money doesn't show up and we have to go in, so it's important to make photocopies of the checks and have the backup, and that's why it's always useful if there is a branch near you. Sometimes when you go in and sit down and talk to somebody, they can help you instead of calling on a toll-free number and talking to a customer service rep from somewhere. So I wanted to mention as well that we just launched, we have a program we call BrokerSync here on myICLUB. If you click on accounting, you scroll down to import broker records. Our BrokerSync program allows you to import the online data from brokerage firms, and we actually just released the functionality for Charles Schwab and Scottrade. So you can see they're in beta there. We also support Folio and TD Ameritrade. So if you use myICLUB and you use any one of those 4 brokers now, we have the function. So every month you can download, so you can automatically import the transactions into your club account. That can help you with your record keeping. As you see here, it says beta after Charles Schwab and Scottrade. That just means that we're still testing those, so we ask you to back up your data first and just let us know. We've got instructions here. You'll log into your account here. It'll tell you what to bring in. It won't duplicate the records if you've got more than one. There's some specific instructions to each broker that we offer there. But if you're using Charles Schwab or Scottrade, we'd appreciate it if you could check those out and let us know how those are working. It's always, we've tested things, but it's always good. There's so many different possibilities of transaction types. Always good to get some other clubs investigating and testing it out. So that's something that we've just released. So sorry, I didn't, almost forgot to mention it, but glad that we were able to get to it. Well, Russell, I think we have just about ended our allotted time, and I see no more questions. So I think we'll wrap it up tonight. I want to thank you again for being with us tonight and sharing your 20 plus years of investment club expertise with us.
Oh, you're welcome. I actually enjoy these.
Great. We will be back next month. If you have any topics that you'd like us to cover, feel free to email me there. There's my email address. We'll try to get this archived webinar up this week, so I would check on Thursday or Friday. We should be able to get it uploaded to iClub.com and available for viewing on demand. Share it, feel free to share that webinar link with other club members if you want them to get on board with improving your club portfolio in 2016. It might help them as well. So thanks again. We'll look forward to seeing you all in April. I hope you've got your personal tax returns all filed with the IRS now. By our next meeting, it's going to be down to the wire. So it'd be great if everyone was able to take care of that and get that headache out of the way for one more year. And hopefully we'll see where we stand with the market. And hopefully it'll continue chugging along as it's been doing so far in March, kind of turn the corner. It's been great to see some of those opportunities that we were able to buy in January and February really start to pay off in March as the overall market has bounced back. So at any rate, remember, stay the course, and we'll see you next time.